the group would be interested in sort of the whole way I got involved in this and how it's evolved. And I started out as what I call a know-nothing. I was a pre-med student and then an English major. And so I had not had a single business course of any variety. When I started as a stockbroker in July of 1968. So I had, in effect, really a clean canvas as to where I should go and what I should do. And so since I knew nothing, my goal was to figure this out. And the investment puzzle started out with, what makes a good investor and what makes a good investment. And I read voraciously and still do. And in the early works that I read that were very important to me were books like John Train's The Money Masters. It was the first written story about Warren Buffett other than a Forbes magazine article and that sort of stuff. And in that, Buffett outlines the only place that I've ever seen it. He gives the characteristics of a great business and the characteristics of what makes a great investor. And that was a very important book to me. I read things like The Intelligent Investor, Ben Graham wrote. In 1972, I came across a book that was reviewed in Barron's called 100 to 1 in the Stock Market. And it was written by a Boston investment manager. His name was Thomas Phelps. And what was interesting to me was that it really made me come around and focus on the idea of compound return. He never actually explicitly talks about compound return, but he identified roughly 350 businesses, public companies, that you could have invested in beginning in the mid-30s all the way up to 71 and made 100 times your money. And in fact, there were a couple of instances where you'd have made 100 times your money in just 2 or 3 years, a really quite extraordinary thing. The difference in all of those, of course, has to do with the rate at which you compound your capital. And so that helped me down that line. And I also read then and still do lots of business biography because it informs me about human behavior, how people behave in their business life and how that affects what they're able to do. So, as I said at the beginning, the puzzle was what makes a great investor? And how do you identify a great investment if, for example, you have a private company? You can't just say, well, the price of the stock went up. If it's private, there's no public share price disclosure. So, the simple way to describe it is if the pile of money at the end of the year is bigger than at the beginning of the year, it's been successful. But if you had a business that had so much opportunity to grow that you invested all the free cash, and so you didn't have a pile of money at the end of the year, you invested it in initiatives to grow, you have to go to your accountant or your bookkeeper or your CFO or whatever, and he says, well, this is what your value was at the end of last year, and this is what your value is at the end of this year. And that's how you know if a business is successful. And it's a really important idea because it just brings you back to the simple issue of rate of return. And so not only how much has it gone up, but on an annualized basis. And then you have things you can compare it to. So in that issue about investors, what makes a great investor, one of the things, you ask yourself, do you take undue risks? How do you define the risks? How do you tell? Have you lost a significant amount of money in an investment? Why do you think you've done that? All of these are important. Sometimes a great investment might be simply described as, well, it met my goal. That doesn't tell you anything. Rate of return, we say in our firm, is the bottom line of all investing. And that's a really important thing to think about. And so about businesses that compound at 8 or 9%. And I said, 8 or 9%, when you compare it to a 1.5% interest rate on the 10-year, is pretty attractive. And everything's relative. I think rate of return is hugely important. And so then I went to discover what the historical rates of return were in all different asset categories: stocks, bonds, art, real estate, oil and gas, collectibles, fancy cars, you name it. And when I was looking at this over maybe 70 years, now over 100 years or something like that, The data indicates that public companies in the United States have compounded at roughly between 9 and 10% a year. And that's better than all other asset categories, and it's unleveraged. So that causes me to ask another question. And that other question is, well, why is that so? Why isn't it 3% or why isn't it 16%? And I'm not terribly mathematically inclined, and so I use the term that it correlates, but I don't do that with a mathematical background. I'm just saying I observe that 9, 10%, not too precise, approximates what these companies are earning on the shareholders' capital. That is, we refer to it simply as ROE. We look a little bit more in depth. We're talking about free cash flow return, subtracting maintenance capex and that sort of stuff on the owner's capital, the capital employed. And so I go from there to posit the following. Our return in an asset will approximate the ROE over a period of years, given constant valuation and given the absence of any distributions. So you all look up at me and you say, well, you fool, everybody knows you don't have a constant valuation in the stock market. So we just work very hard to have an attractive valuation at the start. And as it relates to compounding your capital, your opportunity for a higher rate of compounding is enhanced by a lower valuation. It's just real simple.